This is Robert Kraft, and thank you for joining me today on this Wall Street View. And today on SNN.Network's Wall Street View, I have Gary Mishuris, who is the Managing Partner and Chief Investment Officer at Silver Ring Value Partners. Gary, welcome to this Wall Street View.
Thank you very much for having me.
It's great to have you on. So I know we just did a podcast together not that long ago, but for those who may have missed that, real quick, what's your background and a little bit about Silver Ring Value Investors and Behavioral Value Investor?
Sure, absolutely. So I started Silver Ring Value Partners about 3 years ago, and that was after 15 years at large firms, starting at Fidelity, where I really wanted to get better alignment and focus on investing rather than asset gathering. And then behavioral value investor is really an outgrowth of my strong belief that as a value investor, a lot of the opportunities and challenges, to be honest, are behavioral. So it's the other people's mistakes are behavioral that create mispricings, and it's our own mistakes that are driven by behavioral biases. So I really try to study those and use them as part of my investing process.
Got it. So the main reason I had you on today is because you just recently published an article titled 5 Insights from the 2019 Berkshire Hathaway Annual Meeting. Now, I know my audience, they're big fans of going to the meeting, and
Sure.
I hope to go to the meeting one day myself, and really wanted to dive deep into this article and learn some of the nuances and insights that you gathered at the meeting. So, again, this was about a few weeks ago. So, first things first, before we get into those, for full disclosure, are you a shareholder of Berkshire Hathaway?
I'm not, neither is the partnership.
Got it. So with that, let's dive deep. What were the 5 most important insights that you learned at the 2019 annual Berkshire Hathaway meeting?
Sure. So I think the first one that was really at the heart of the current raging debate in the value investing community is, what does it mean to be a value investor, actually? And so that was, I would say, the biggest with the purchase of Amazon, and I'm sure we'll talk about that Berkshire made disclosed right before the meeting. So that was number one. I think the next one that was really about the nature of business quality. Like, what does it mean? Like, what's a good business? Like, what is it, and how durable is that? And Charlie Munger really talked a lot about that. I think finally, kind of maybe it's everyone hears what they want to hear, but to me, there was a lot of talk about behavioral biases and the use of checklists, which I'm a big fan of, to really try to minimize those. So that was good to hear, and certainly a consistent theme throughout the years. The fourth, I know Buffett is really not a fan of the investment management industry, and I think rightly so, right? As an industry, the industry hasn't painted itself with glory, nor really on average helped the small investor. And there was a lot of discussion about what is a good way to manage money, what is it not, and also kind of like what you should and shouldn't do. So I think those were helpful. And finally, and I think this is where Buffett is really the master, it's how do you learn and evolve? Because I think that really is what sets them apart. And there were some useful tidbits there about how do you go about that as an investor.
All right.
So those are 5.
Cool. So let's take a deep dive into each one of those 5. So the first one, you talked about the meaning of value investing. Again, it sounds like they covered a wide array of topics, including diversification, valuation, and more.
Sure.
So what did you find that they said that was nuanced to you, or something new that you hadn't really heard them talk about in terms of value investing?
Yeah, so I think, like as I said, the big kind of surprise right before the meeting was the disclosure that one of Buffett's lieutenants bought Amazon. So the value investing camp has been split into 2 kind of groups, right? There's the people who are focused on, value investing is about buying cheap stocks, right? It has to be at some multiple of earnings or cash flow or something. And then there is this growing part, probably the majority now, of saying, well, price is interesting, but it's a secondary consideration. We really want high quality businesses, compounders. We want to buy the big moats and so forth, great management teams. And so when Buffett, kind of said Berkshire bought Amazon, eyebrows went up, and people said, hey, he's kind of joining that camp of saying quality matters more than price. So I think there was actually a much more nuanced view, and he said 2 things that really stuck with me. One is, he said, you can pay too much for a wonderful business. And he talked about how See's Candies, no matter how good of a business it ended up being, that there was a price which would have made it a bad investment. And I think that, the one nuances, again, he said, you can turn any investment into a bad deal by paying too much. What you can't do is turn any investment into a good deal by paying a cheap price. So I think that's very insightful. But then he went on and said, look, buying Amazon, as long as you're following a value approach of thinking about the intrinsic value of the business, is as much value investing as buying some cigar butt that's dirt cheap. What makes it value investing or not is the process. Are you valuing it based on what the business is worth, on the cash flow stream and the assets, or are you just speculating on what someone else will pay for it tomorrow? So his point is it's the process that makes something value investing, not just what stock is that you buy. That being said, he hasn't bought it. So I think he's happy to have his lieutenant be a little bit more adventurous, and maybe it's within his circle of competence. But I think Buffett so far hasn't joined the gang of buying all the FANG stocks and saying that's the way I'm going to deploy capital.
I mean, he needs to step up his game, right? I mean, he's been so unsuccessful for so many years. Right. I mean, why stick to your own knitting, right? I mean.
well, I think by the way, that's the other nuance too, is that what can be a good investment for you, given your circle of competence, can be very different than for me. So it's not an absolute thing where it's, hey, if you don't buy Amazon, you're stupid. It's like, hey, you might be able to underwrite that investment, but I might not. And so I'm okay with that, and I'm going to pass because for me, it's a pass, but for you, it might be a good investment.
Right. So then your next point that you brought up was about the nature of business quality. So, let's dive deeper in here. What was their thoughts on the nature of business quality? What did it mean to them?
Yeah, and I think Charlie Munger gave an interview to Jason Zweig from the Wall Street Journal right before the meeting. And there was a number of things he said, but kind of maybe as a backdrop to this current period is somewhat reminiscent of the 1960s in terms of you had this nifty 50, these great businesses that were around, and they seemed to be infallible. They were going to grow forever, and they were going to be amazing, right? Polaroid, Kodak, Avon, all those, IBM. And the thing is, you could never point to a specific thing that was going to make them no longer good. And yet, a number of them became, after a long period of time, no longer good. So the burden of proof is not, can you show what's wrong with a Google or Amazon or Facebook, but just knowing that business changes, new technologies come about, and that Charlie Munger's point is that if you start with 100 largest companies in 1900, that there's only one on that list today that was on that list 100 years ago. So there's a very high mortality rate. Some of it is acquisition, but a lot of it is just business changes. And you can't always pinpoint what's going to kill a business, but you better believe there will be something that's going to be trying to do that. And I think the other point that Buffett went into with the Kraft Heinz discussion was brands versus retailers, right? So you always have this tension of who has the more power in the value chain. Is it the retailer or the brand? And right now, it seems that the balance of power has been shifting a little bit more towards the retailers. So the point that he made was that if you have a very strong brand, like Coca-Cola, for instance, that you're still good. And they gave an example because Costco, where Charlie Munger is really involved, they tried to remove Coca-Cola and replace it with some generic soda, and it didn't work. They had to bring it back. But if you have a kind of a medium or a weaker brand, then the retailers can really get you in the age of Walmart and Amazon and online retail. So I think that it's much more important now to either have one of the top brands, or it's not much of a moat at all in retail. So I think that was the insight there.
Got it. So really the main point was that you really have to look at the moats, and really understand.
And that because the pace of change is accelerating, that you can't be complacent as soon as a business that's good today is going to remain good in 5 years, for instance.
So then the third insight that you talked about was rationality versus behavioral biases. And on this point, what I wanted to know is what were the 3 ideas to consider for making better investing decisions?
Well, I think the first thing that Munger recommends, and I think this is spot on, is to create a checklist, right? And there are a bunch of ways to do that. One is to look at or study other people's mistakes. You can obviously study your own mistakes, but you're going to do even better if you start studying them before you make them, right? Because why wait till you make them? But there are common biases, and he's systematic about creating a checklist of he's not a very politically correct gentleman in terms of his the choice of words, but he calls every asinine decision I've ever made, I put on the list so that I don't make it again, right? So I think studying failure is super important. I think that's one. I think that another point that they brought out is seeking out an opposite point of view. Basically making sure that you're fighting that confirmation bias that we all have by seeking out a strong alternative view that actually challenges your beliefs is very important. Which, by the way, is hard. We all have a tendency to live in this intellectual echo chamber where we want to just hear people who agree with us, and it's super important to actually seek out those who disagree with us. I think, and I think the final point is, despite all of that, even if you do it, it's really hard. It's actually really hard, and you shouldn't assume that even if you do all these things, you're going to be perfectly rational, but you can sure get a heck of a lot closer to being rational if you do these things than if you don't.
Got it. And then you also made 3 great points regarding the business of investment management, on this topic. This is actually for point 4. So for you, what are they?
So I think the first thing that Buffett always gets asked, some young, usually it's a man, but young person, let's say, stands up and says, Mr. Buffett, I would love to manage other people's money. How do I do it? Like, what's your advice? You did it in the partnership days. What do I do? And the first answer he gave is that you should only manage other people's money if you can get the kind of investors who will stick with you when you have a bad period in the market. And that's so true. So, if you have the kind of investors who will leave as soon as you have a bad year, your time horizon gets really shrunk, right? And you can't invest for the long term. You can think to yourself that you can, but if your capital leaves you, you can't. So if you can't get the right duration of capital, it's better off not trying. And that's very true. And that's, by the way, one of the ways that I actually, it's a mutual selection process. Obviously, a potential partner who invests with Silvering needs to select me, but I actually select them as well. And I have a checklist. I don't show it to them, but I have a scorecard. And one of the main characteristics is, are they truly long-term and process-oriented, or are they just, chasing short-term returns like the vast majority of investors? And if they are, I let them go to someone else because it's going to be a distraction and a negative for the rest of the partnership. So I think the second point, and this is one that's Munger made, that is that people come out of the womb with delayed gratification skill, and you can't teach it. People either have it or they don't. So it's like maybe it's the cookie test when you're 4. Most people just want short-term results. They want, to eat jam today. They want to, do that kind of stuff. And they can't say, well, I'm going to invest and it's going to play out over 5 years or 10 years and it'll be fine, but the first couple might be rocky. So I think he said it's very important to have that ingrained personality trait almost. It's not a learned skill. And then the other point that both of them made is that you can invest small sums of money at very high rates of return. But as soon as your assets rise, your returns really diminish. And I think I love the quote from Munger. I've seen genius after genius with a good record, and pretty soon they have $30 billion under management and 2 floors of young men working for them. And away goes the good record. And I've done this for 18 years. This is so true. And by the way, people, even well-meaning people, they tell themselves all kinds of stories, and they fool themselves. They say, I got better, so I can manage more money. I have another strategy. I hired more research analysts. And I've almost never seen someone with tens of billions of dollars produce an amazing record. And even if you look at Buffett, Buffett's been an amazing investor, but his best returns have not been when he was managing the most money. It's been when he was managing the least money in the partnership days. So I think part of the reason I started Silvering was to get in a structure where it wasn't about chasing more and more billions. It was managing a relatively small amount of money, but really well.
Right. So in closing, his last insight, you alluded to this at the beginning, and that has to do with Buffett and Munger's advice for how to learn and evolve. So with that, what was their advice for how to learn and evolve?
Sure. So I think there's a tension that Buffett points out between staying within your circle of competence and growing the circle of competence. And so, because, day one, you're born, you have no circle of competence, right? So you obviously have to grow it. So same as you start investing, you have to grow your circle of competence a little bit. But if you grow it too much and you become arrogant, you're going to go outside of it. And one of his well-known quotes is that the size of your circle is not nearly as important as knowing its boundaries, right? So his advice is you have to read a lot, read, and you have to study businesses. And that's what he does. He really studies businesses day in and day out. He reads 10Ks, annual reports, and he really wants to understand both success and failure. And I think that that's what you have to do. And with that, you reach a point where you're going to plateau at some point, and then it's your decision that's individual to you. Is do you want to push your circle forward, or do you want to just stay pat and say, you know what, I've reached my boundaries? And that's, I think that's where the art is. And I think if you look at Buffett, he's such a great investor in large part because he evolved and he expanded his circle many times during his career. Otherwise, he would be just another good but not amazing investor. Instead, he's the best investor in the world.
And Gary, for full disclosure, do you own any of the following names? Amazon, Facebook, Google, Kraft Heinz, Costco, Coca-Cola, or Walmart?
I do not own any of them, and neither does the fund.
And so, Gary, where can my audience go and find more information about you, subscribe to your YouTube channel, and also your website?
Sure. So 3 places. Silvering Value Partners is a site, pretty sparse, just about the firm. I publish articles at behavioralvalueinvestor.com. And my YouTube channel is just under my name, Gary Mishuris, and you can just subscribe and look at the various content there, and I'll plan to post regularly new content every week or so.
Gary, thank you so much for joining me today and for writing this article. And are you going to go back in 2020?
That's the plan.
All right. Well, hopefully I'll see you there.
All right. Well, thank you so much for having me. Really appreciate it.
Thank you.